Pre-planning clients' acceptance. According to International Standard of Auditing (ISA 220), engagement partners should be satisfied that appropriate procedure regarding the acceptance and continuance of client relationship and specific audit engagement has been followed, and that conclusions reached in this regard are appropriate and has been documented. For International Standard on Quality Control (ISQC) state, the firm should establish policies and procedures for the acceptance and continuance of client relationship and specific engagement, designed to provide it with reasonable assurance that will take on only undertake or continue relationships and engagement where it has considered the integrity of client, auditor is competent to perform the engagement and has capabilities, time, and resource to do so, and can comply with ethical requirement. Procedures for evaluating prospective clients. First, integrity of those in charge with governance. Second, obtaining and reviewing financial information of prospective clients. Third, information of third party. Fourth, communication with previous auditor. And lastly, evaluate the firm's independence and ability to service the client's requirement. Procedures for evaluating existing clients. First, integrity of those in charge with governance. Second, obtaining and reviewing financial information of prospective client. Third, information from third party. Fourth, communication with previous auditor. Must get the client permission. If not allowed, must decline it. And lastly, evaluate the firm independence and ability to service the client's requirement.
Moving on to the knowledge in clients' business and industry. It is important for an auditor to develop an understanding of the business and industry to assess the business risk and risk of material misstatements or frauds. There are few factors that increases the importance of understanding the client's business and industry, which includes clients may have expanded operations globally, or there is an increase in human capital and other intangible assets that has increased accounting complexity and the importance of management judgments and estimates. Now, there are two tools that can help us to understand the client's business and industry. One of them is the industry and external environment. The auditors must have understanding the industry in which the client is operating in. This also includes the level of competition, nature of relationship with suppliers and customers, and the level of the technology used. This may cause risk to rise for the clients and the specific industry that they are operating in. The auditor must understand that many industries have unique requirements. For example, if the client is working in the agriculture industry, the auditors need to know the agriculture industry uses GAP, which is Good Agricultural Practices, as the standard requirement. What is the importance of doing so? The importance is the potential impact on the financial statements and on the planning of audit. For example, if the client operates in highly regulated industry, the firms may consider sending a person with specific experience and knowledge of those regulations to audit for the client. The regulations include financial reporting framework and whether it uses local or international standard. Now, moving on to the second one, business operations and processes. An auditor must understand the legal structure of the company, which includes the ownership and governance structure of the company, key customers and suppliers, sources of financing of the company, and the accounting policies selected and applied to the financial statements of the company. They must make sure the policies are applied consistently with the approved standard, which shows their integrity as an auditor. The auditors also need to obtain more information about related parties. This is because it may indicate the areas of increased client business risk. The related parties. The parties are considered to be related if one party has the ability to control over the other party or has an influence over them to make financial decisions. For example, the auditor may tour the plant and offices to better understand the operations and talk to the key personnel to obtain information about other parties related to the company. The auditor may see it as a precautionary step to ensure that they can help clients to reduce the risk. Auditors also need to identify any related parties to the company for the purpose of disclosure. According to FRS 124, the company is required to disclose transactions with related parties in the financial statements if they are material.
Moving on to the materiality in planning and performing an audit. Misstatements are considered to be material if they could influence the decisions of users of the financial statements. Judgments about materiality are based on surrounding circumstances, including the size and nature of the misstatement. Judgments are based on the user's common needs as a group. It is an auditor's job to know how big a misstatement has to be before it significantly affects the user's judgments. Planning materiality must be done before the commencement of detailed testing. Materiality must be revised as the audit progresses if the information revealed caused the auditor to set to lower materiality. It is assessed at least once during the conclusion of the audit, that is, before issuing the audit report. This is viewed as final materiality. A relationship exists between audit risk and materiality. It is an inverse relationship. The higher the audit risk, the lower the materiality will be set. The lower the audit risk, the higher the materiality will be set. There are two types of materiality. First is quantitative and the other is qualitative. Now, talking about quantitative, it refers to the misstatements or omission which the cause of them could influence the user's economic decisions. It means that the auditors needs more evidence to reduce the quantitative materiality. For example, 5% of sales revenue drops to 1%. This could influence users' economic decisions, and they can help to quantify the number of misstatements available in the financial statements. Now, moving on to the qualitative factor. It is already stated in the definition that misstatements or omission can be both qualitative and quantitative. So, qualitative refers to misstatements that are immaterial. Qualitative materiality also refers to if a disclosure is omitted from the financial statements, or the misstatement or omission that reverses the loss to profit or profit to loss. Qualitative materiality is measured based on the amount. For example, the disclosure is omitted from the financial statements may affect the company's policy, and this may cause business risks.
Next, I will explain about scope of audit. First is the engagement letter. Engagement letter usually refers to a letter from an auditor to a client. The letter is also an agreement between auditors and clients on any forms of written materials prepared for the interests of both parties. Well, what is the purpose of engagement letter? Well, firstly, it is to provide written confirmation of the acceptance of appointment. It is also to define the scopes of audit, responsibility, and objective of audit. It is also to minimize the possibilities of misunderstanding between clients and auditors. Well, moving on to fraud and error. Fraud is basically an intentional misrepresentations of financial information by one or more individuals among management or employees or third parties involving, well, first, the manipulations, falsifications, or alterations of records or documents. Secondly, the misappropriations of assets. Thirdly, the suppressions or omissions of the effects of transactions from records and documents. Next is recording of transactions without substance. And lastly is the misapplications of accounting policies. Example of a fraud is when the accountants intentionally manipulate or alter the financial statements for his own use. Moving on is the error. Unlike fraud, error is the unintentional mistakes in financial information. For examples like mathematical or clerical mistakes. Next is the oversights or misinterpretations of facts or the misapplications of accounting policies. Example of an error is when the accountant is using the reducing balance method as compared to the straight line methods that the company used the year before. Moving on is to set audit objective. Is the management assertion. It is generally defined as implied or expressed representation by management about classes of transactions and related account in financial statement. The Public Company Accounting Oversight Board or PCAOB standards describe there are 5 categories of management assertion. First one is the existence and occurrence. Second is the completeness. The third one is the valuations and obligations. The fourth one is the presentations and disclosure. However, there are 3 categories of assertions as mentioned in AICPA and IFRS. First one is the classes of transactions and event. Second is the account balance. And the third is the presentations and disclosure. In transaction-related audit objective, generally there are 4 objectives that we can discuss here. First objective is the occurrence. Occurrence describes that all transactions included in financial statements must be recorded during the accounting period. Next is the completeness. Completeness can be described in both transactions and accounts balance related audit objective. It is basically explained about all transactions and accounts are included in financial statements. Next is the measurement, or sometimes can be described as classification. It is basically says that transactions are located at the proper amounts and also at the proper period. And last but not least is the presentations and disclosure. It says that financial statements must be properly presented at the end of the accounting period. Moving on is the balance-related audit objective. Both transactions and the balance-related audit objective are generally similar, but there's a few differences between them. The assertions about existence. It means that all asset obligations and equities included in the balance sheets actually exist in the balance sheet state. Next is the right and the obligation. It basically says that assets are the right of the company and liabilities are the obligation of the entity at the specific given date. And the last one is the valuations. It says that all assets, liabilities, equities, revenue, and expenses are in appropriate amount.
Achievement of organizational goals and objectives. Business risk can be also lead to the audit risk because it is affect the financial statement that will be audited by the auditor. Now we are going to the main component of the business risk. There are 3 main components of the business risk, such as first, financial risk, Second, operational risk, and the third one is the compliance risk. The financial risk is where risks arising from the company activity, such as overtrading in the transaction. The operational risk is risk that arising from the operation of business, such as loss of physical asset. The third one is the compliance risk, which is arising from non-compliance with law and the regulations. The example of the compliance risk is the breach of the Company Act of 2016. Now we are going to the audit risk. Audit risk is the risk arising from carrying out audit work. The audit risk is the audit that an auditor expressed an inappropriate opinion on the financial statement of the company. Example of inappropriate audit opinion in reports. First, audit report is unqualified but subsequently material error is found in the financial statement. Second, audit report is qualified but subsequently no material error is found in the financial statement. Now we are going to the audit risk. The first is inherent risk. Second is control risk. Third is detection risk. The inherent risk is the risk of a material misstatement in the financial statement arising due to error or omission as a result of factors other than the failure of control. Generally, it is considered to be higher where a high degree of judgment or where transactions of entity are highly complex. The example of inherent risk in the audit of newly formed financial institution which has exposure in complex derivative instrument. Next, we're going to the control risk. It is risk of a material misstatement in the financial statement arising due to absence or failure in the operation of relevant controls of the entity. It also considered to be high when the audit entity does not have adequate internal control to prevent and detect presence of fraud and error in the financial statement. The example of this is in the case of small size entity in which separation of duties is not well defined and financial statements are prepared by individuals who do not have technical knowledge of accounting and finance. Now we are going to the last risk, which is detection risk. It is risk that the auditor failed to detect a material misstatement in the financial statement. The example of it is misapplication or omission of critical audit procedure may result in a material misstatement remaining undetected by auditor. Some detection risk always present due to the use of sampling for selection of transaction. That is end of the client business risk.
Next is the preliminary analytical procedures. What is analytical procedure? Analytical procedures are performed during the planning phase of the engagement to assist the auditor in determining the nature, extent, and timing of work to be performed. Preliminary analytical procedures also help the auditor to identify accounts and classes of transactions where misstatements are likely to be present. There are three types of preliminary analytical procedures. The first one is industry data, where the data comes from the competitors. The second one is similar prior data, which are the company's past data. The last one is budgeted data, which is the expected results of the company. Comparisons that are useful when preparing the preliminary analytical procedures include comparing the clients with the industry data. Next is comparing the clients with similar prior period dates. The third one is comparing the clients with client-determined expected result. The fourth one is comparing the clients with auditor-determined expected result. And finally, comparing the clients with expected results using non-financial data.